Are you ever concerned about risk in your portfolio, especially in a volatile market? Well, in this episode, Merce and I are going to talk all about how to deal with that risk, how to manage it, what you even need to know so that you can have peace of mind through your entire retirement.
To learn more about how to secure your retirement and all the different elements you need to know, please subscribe to our channel and hit the bell so you'll be notified when we release episodes every Monday. We have helped hundreds of our clients gain clarity and get on the path to a great retirement. Now it's your turn. Let's dive in.
Welcome, everyone, to Secure Your Retirement Podcast. Today, we're talking about a topic that's got of interest to everyone, and that is growing their money, getting a return on their money. And we're really kind of giving this one a theme of active management, the kind of the pros and cons versus a buy and hold, especially in retirement. So how does active management work in retirement? That's kind of the process. But to get us a little bit of a context here, I think it's kind of important for us to think through maybe kind of this high level differences between how we would invest. Because here's the thing. If a person says to us, I don't want risk on my portfolio, well, then where could you go to have no or low risk, very low to no risk? Everything has a risk, by the way. Low to no risk. What would that be? Well, I could put my money in the bank. I could put it in a CD. I could go and buy even treasury bonds, which are pretty safe. Or I could go and buy a fixed annuity. And I say, look, I just don't want any risk. I'm okay making 2, 3, 4%. Right now, you can make around 4%, so that's good. But I want to put all my money in those kinds of environments. Well, that's okay because I'm saying I don't want the risk. That's fine. But what happens there is I'm kind of locking myself into a pretty conservative low rate of return. I don't really have any growth opportunities there for that money. And by the way, a lot of our clients put a percentage of their money in those places that I just mentioned, and we think it has a good place. But if I'm looking at 100% of the money, a lot of times people say, no, I'd like to have some of my money going out there and going and getting some growth. Well, now I have to introduce the portfolios out there and say, hey, I've got to go into stocks and bonds. And that's just making that a really big, broad picture. But the reality is once I do that, I've got to make a determination of how do I want my money invested within stocks and bonds. So one person could say, I just want lowest fees possible. So just go buy me an index fund. In fact, I could just go buy an index fund that mimics the S&P 500. And I just say, hey, if it's up, it's up. If it's down, it's down. The thing you have to realize, though, that if I mimic the S&P 500, I'm going to have all of the risk of the S&P 500. And what does that mean? Well, now I go back and I look in the years like 2000, 2001, 2002, the stock market dropped 50%. If you had $1 million and you dropped 50%, now you're at 500,000. If you're taking withdrawals on that, that is not good. 2008, the stock market, the S&P 500 dropped 58%. In 2020, it dropped 34%. And so now I'm going, whoa, okay, I want to make the good returns, but I cannot handle that kind of risk, especially if I'm close to or in retirement. Because if I'm withdrawing from the portfolio and it goes in half and I'm still withdrawing it, it's a compounded problem. So now the other level is I do something again, super basic. I say, let's take 60% of the money, leave it in the market, like an S&P 500 look, and then 40%, and I go put it in the bond market. Well, then comes something like 2021, 2022 timeframe, and the bond market crashes. Well, now my 60-40 portfolio is down as much as the market's down. And I go, wait a minute, how did that happen? And so now we grow and we say, wait a minute, now let's look at how do we manage this risk that could be in stocks and bonds. And that's where we kind of come down this path of actively managing the account. So actively managing means we're going to transition the portfolio so that it's in the good places it can be. But it also could mean that we reduce risk. Now, I'm going to transition this over to you, Merce, because I kind of want you to, so I'm just trying to give you the visual. The visual is saying, hey, I want to be able to be in the market, get growth, but I don't want all that S&P 500 risk. So how do I do that? And then we can talk about the pros and cons.
Yeah, so in an active management strategy, the idea is that we are going to be moving around within the market. That's what active management is, based on metrics or data points or however the money manager is running the money. You could have one strategy that is very aggressive that says, I want to be outperforming and doing better than the markets. That's typically what hedge funds align themselves with. to do as good as they possibly can, which means they're also going to take on sometimes more risk in that buy and hold type of scenario. And then you have an active management strategy like ours that is really about good risk management. It's not all about trying to hit the home run rates of returns, because those home run rates of returns also come with the large amounts of risk that, quite honestly, our clients just do not want to deal with anymore. They come to us and they say, hey, I'm 10 years away from retirement. I'm 5 years away from retirement. My earning years are greatly reduced now. My ability to save is greatly reduced now. I've got what I've got, and I need to make sure that it's going to last. And I can't afford to go through another 2008, 30, 40, 50% type of sell-off. So how can we do this? How can we be invested in the stock market and be able to mitigate the risk of what the market brings? Last year, 2022, the S&P was down about 20%, right? It's still very fresh for a lot of people. And what I tell some people is that it was a gut check for a lot of us as far as how we are exposed to risk today. So how can we mitigate some of that risk? And in our opinion, it does need to be actively managed. So there are portions of the market that do really well in given situations, and there are portions of the market that just do not perform well. You can talk about where we're at with the inflationary environment that we're in, debt ceiling issues, the pandemic. There are portions that did really well during the pandemic. Take technology, for example. Large caps like Amazon, for example, did very, very well throughout the pandemic. And then a lot of the other asset classes suffered. So in our opinion, we need to track what's doing well and what's not doing well, and let's be a part of that. And really what that boils down to in a simplistic way of looking at it is that there is a time to be invested in what we believe are the best places to be invested at the time. And then there is a time to have risk that is reduced, or taking some of that risk off of the table and going into more stable investments. And it's all data driven from the way that we look at it. So what's going on right now with the debt ceiling crisis and inflation, we're not guessing as to how the debt ceiling is going to be resolved and making investment decisions based off of that. With inflation, we're not guessing as to where the Fed is going to go with interest rates and making decisions off of that, or this potential impeding recession that could be coming at the end of the year and the first of next year. We're not guessing and aligning the portfolio that way. We're purely going off of data. The data and the numbers that are coming in the door help us see what are the best asset classes to be invested in right now. And so let's align the portfolio a little bit that way, knowing that those asset classes are going to move, and we need to have the ability and the flexibility to move within what the data is telling us. So that's really a high level as to what we believe is a good risk management philosophy. Again, there's pros and cons to investing in general. There's pros and cons to everything that I think everyone should understand. But at the end of the day, you want to pick a strategy that is comfortable to you. And I'll go back and say it, that our clients that come to us, they say that, hey, I want to make a decent rate of return. My plan is going to work great off a decent rate of return. I cannot afford to lose a bunch of money at this stage in my career as I approach retirement.
Yeah, it's funny. I was listening to a podcast. Actually, I listen to podcasts all the time. I know Merce does as well. Mm-hmm. And I was listening to a podcast, and in this podcast, it was an industry podcast, meaning it was another financial advisory type podcast where they would interview people who actually own their own advisory firm. And so the person was asking, well, what is your investment philosophy? How do y'all, in all essence, manage your money for your clients? And she said, well, we used to do kind of what we're describing here, which means we had a part of the portfolio that was a little bit more invested all the time, and then a part of the portfolio that we actively managed, and that we would manage the risk over there. And ultimately, she says, as we went down that path, she says we really weren't set up to be able to have the trading involved that we needed to do. And she says it was just a lot of work to be able to do all that. And so she said, we just, because of logistics, opted to go to a buy and hold strategy, because a buy and hold strategy is pretty easy for an advisor to manage. With a buy and hold strategy, the most that I'd have to do is do a balancing of the portfolio either on a monthly or quarterly basis. And I will tell you, in our world today with technology, that is a press of a button. I mean, it is zero complication for us. And all we do is go and put in the parameters that we want it met. We press a button, and the software goes out to all of the accounts and makes those rebalances. and it's done. I mean, it takes me no time at all. But if we're going to actively manage the risk in the portfolio, there's a lot more work involved. We've got to look at things on a daily basis, not that we're trading every day, but we're going to make adjustments to the portfolio on a much more regular basis. Now, we believe that is what we want. That is how, by the way, all of us have our money invested that way. So we want to have our money, the risk on that money managed as well. And so we've set up systems to be able to do that. But I will tell you, the vast majority, if you were to go out and talk to a financial advisor, they're going to operate on a buy and hold strategy. Now, again, we're not trying to get into a battle. Is buy and hold better than active? Or, risk on, risk off, is that better than just buying the market? Because that's what's being told a lot, is just buy the market, hang in there, don't let go, and survive, and it'll come back. Don't worry, it'll come back. And as Merce said, I think a nice job, is for people with long-term horizons, they can actually afford to have it go down a little bit and come back because they're not going to touch it. I will tell you, though, even if you can afford it and you say, hey, I don't mind if I'm down 50%, it's okay to me because I'm not going to touch the money anyway, emotionally, that can be very difficult. I mean, we do a risk conversation with all of our clients that are going to become our clients. And we kind of take them through that whole idea. If you were to lose X amount of money in the next 6 months, at what point would you decide that that's too much, I can't handle it? And we start and we show them real dollars. So just in your mind, take $1 million account. If you're down 10%, I don't know, that doesn't sound that bad. But if I say it's $100,000, that sounds real bad. Or if I say you were down 20%, $200,000. Well, all of a sudden, people, when they see those numbers, they start to go, yeah, that 10% is kind of the threshold. I'll say our average client says around that 10 to probably the high side, 15%. They're starting to get really nervous. Well, how do we manage that? Well, we say, look, let's reduce risk on the portfolio. So, by the way, if we have a part of the portfolio that's pretty much always invested, but it's only, say, 40% of the portfolio, the other 60% is being risk managed, I don't have all the exposure of the market, but I also have opportunity on the portfolio at all times. And so that's kind of how we operate, and that reduces that risk significantly. So Merce, what would you say about, I know that you have a chart that you look at that kind of shows a little bit like how that operates, why active management could be a good thing on either side of the portfolio. When you think about different asset classes, how they operate from one year to the other.
Yeah. So the thing about asset classes is that some are working in a given year and some are not working in a given year. And, when we're talking about asset classes, this is very broad based of what the market is comprised of. You've got large cap stocks, small cap stocks, international investments, emerging market investments, REITs, which are real estate type of investments. And then you've got the area of the bond world, which is, high grade investment bonds, high yield investment type of bonds. And then you've got cash or treasuries, basically. And there's a chart here that you can easily find if you were to Google asset class returns over year, and it shows you, basically it looks kind of like a periodic table of how often one asset class moves around year by year by year. So 2022, it's not out of our minds yet. The S&P was down about 20%. The NASDAQ was down closer to around 30%. Don't quote me on that, but somewhere in that realm. 2022 was a bad year. Cash or treasuries was the leader of the asset classes last year because everything else was down, right? We think about bonds and we think about how they go to that 60-40 portfolio. There's the bond side of the portfolio is supposed to save us. It's supposed to provide safety. It's supposed to provide income. And the 60-40 portfolio in 2022 and 2021 just did not do well because bonds were down. In 2022, the high yield bond arena was down 11%. The high grade investment bond arena was down 13%. And we're talking to people and their bonds are down almost as much as the stock market, and they're saying, I didn't even know this was possible. I thought the bonds were managing the risk of my portfolio, but they lost a significant chunk as well. And so monitoring how asset classes move, we believe is a good way to structure the portfolio. Not saying that if we're seeing that small cap is the leading if we're talking about a race, right? The leading car in the race, we're not going to say let's go all in on small cap. That would be irresponsible. But could we put a little bit of a leaning towards that? Absolutely, we could. And we track that measurement, knowing that things are moving on a monthly basis, on a quarterly basis, on an annual basis, and we want to keep up with that as best as we can.
Yeah. So I want to, hopefully this is the messaging. The messaging is, if you don't care about losing a bunch of money because you're just like, I'm just not going to worry about it. If I'm down, I'm down. And if I'm down 50%, I believe the market's going to come back. There is a subset of people that believe that, and that's okay. We are not trying to tell you that buy and hold is inferior to an active managed approach. What we are saying very clearly is that we can reduce risk on the one side, whereas on the other side, it is what it is. You just ride the mountain down to the valley if that's what happens and that's what occurs. What we believe, though, and what we're comfortable with, what the clients that are attracted to us are comfortable with, is like, hey, let's manage this risk. And if I can make a decent rate of return and not lose a bunch of money, I'm golden. Many times we show a client, a potential client or clients, hey, if we just make 6%, 7% on average over your retirement, you're going to be completely fine. So that's not saying we're limiting that. What we're saying is, though, the client understands, hey, if I can make a decent rate of return, not lose a bunch of money, and I can sleep well at night, I'm going to have a great retirement. I'm going to have peace of mind in retirement. If I've got all that exposure, I'm nervous and I'm on a vacation, but yet I'm still thinking about my money, and I don't want to have to think about that. So if that's not appealing, and you say, nope, I would like to have this peace of mind, being able to sleep well at night kind of scenario, well, then you could explore that as a topic. So we hope this is at least giving you a little bit of insight on how this works. If you decide you'd like to have a conversation with us, please reach out to us. You can go to our website, top right-hand corner, click on schedule call. Our calendar comes right up, and you're able to go in and schedule that 15-minute complimentary, no obligation phone call with us. We're glad to kind of walk you through the strategy, show you exactly how this could work in your overall plan. So feel free to reach out to us. We hope this has been of some benefit. We'll talk to you again next Monday. We hope this video has given you some confidence and clarity as you plan for a worry-free life in retirement. But what else do you need? We have created a complimentary video course called 3 Keys to Secure Your Retirement. This video walks you through step-by-step what you need to do to get ready for retirement. You can also check out our podcast called Secure Your Retirement. You can subscribe below.
For more retirement tips, check out these videos. Also, if you find them valuable, please subscribe to our YouTube channel and give us a like.